Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at CoreWeave.
If you find our talks useful, please consider subscribe, like, and comment underneath to support this show. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. When you look at CoreWeave, you're really looking at a pure play on the AI infrastructure boom.
The growth here is it's explosive.
It really is. The numbers look more like a software company, not, a company that has to build massive physical data centers.
Exactly. And that's what's so compelling. Just look at the Q3 2025 results. They pulled in $1.36 billion in revenue,
Which is a huge year-over-year jump, right?
133.7%. And crucially, they didn't just meet expectations, they blew past them. The consensus was, closer to $1.28 billion?
Right, so they beat soundly. But with that kind of growth, you always have to ask, is it growth at any cost? Are they just burning cash to get revenue? That's the million-dollar question, and the margins tell the real story here. This is what separates CoreWeave from the pack.
The efficiency.
The efficiency. We're seeing incredibly strong gross margins at 73.9%. And even more impressive, their EBITDA margins are sitting at 50.5%.
50%. I mean, for an infrastructure business, that's almost unheard of. Just shows the operational leverage is massive.
It is. So even though they're posting net losses right now because they're pouring billions into CapEx, buying GPUs, building out, the underlying business is a cash flow machine.
And they're even managing that loss better than expected.
That's the other part of it. The EPS loss was only 22 cents. The street was expecting something closer to a 36-cent loss. So they're spending a ton, but they're spending it wisely and efficiently.
And that CapEx includes things like advanced liquid cooling systems, right?
Yeah.
So it's not just buying hardware. It's optimizing it for the long run.
Precisely. They're building for performance and longevity.
Okay, so let's unpack why they can get those margins. What's the moat? I mean, they're up against giants like AWS and Azure.
Yeah.
Can't compete with them just by being good. You have to be different.
And that's exactly it. Their whole business is the moat. They're not a generalist cloud provider.
Right. They're not trying to run your WordPress blog.
Not at all. They are a purpose-built, highly specialized AI cloud. They do one thing, and they do it better than anyone.
They're a specialist garage for Ferraris, not a general parking lot.
Perfect analogy. And that specialization comes down to the hardware. We're talking about massive integrated systems like the NVIDIA GB300 NVL72.
Okay, break that down for us. Why is the GB300 so important?
It's all about density and speed. It basically combines 72 GPUs and 36 CPUs into a single liquid-cooled rack. For an AI company training a huge model like, say, Runway with their video models, this setup is a game changer.
Because all the GPUs can talk to each other super fast without bottlenecks.
Exactly. And that creates incredibly high switching costs. Once you build your AI model to run on CoreWeave's specific architecture, moving it to a generic cloud would be a nightmare.
And this is where the partnerships become so critical, right? It's not just about the tech they have today.
Yeah.
It's about the tech they're getting tomorrow.
Yes. This is a point that you just can't gloss over. Their relationship with NVIDIA is strategic. They're getting exclusive access to next-generation tech like NVIDIA Rubin.
And that level of access is usually only for who? The absolute biggest players.
The biggest. We're talking Amazon, Meta, Google. The fact that CoreWeave is in that club tells you that NVIDIA sees them as an essential partner for rolling out their most advanced AI systems.
So they get the best chips first, and they get a guaranteed supply. That's a massive competitive advantage.
It's an enormous advantage, but we have to talk about how they're paying for all this kind of growth, this exclusive tech.
It's
incredibly expensive.
Right. This is where the story gets a little scary. The balance sheet. This is where the bull case and the bear case really collide.
It's a classic high-leverage growth story. The expansion is funded almost entirely by debt. I mean, we're looking at a debt-to-equity ratio of 2.66.
And the liquidity is tight. The current ratio is 0.49.
It's very low. For anyone not familiar, that means they have less than 50 cents in current assets for every dollar they owe in the short term. In most industries, that would be a huge red flag.
A sign of major distress. So how worried should we actually be?
You have to put it in context. They're building things that cost billions up front, but they often have multi-year contracts in hand for that capacity, so the revenue is coming. It just doesn't line up perfectly with the financing schedule.
So it's a calculated risk, an aggressive strategy to grab market share now while the getting is good.
It is, and the scale is just staggering. They recently had a $2.6 billion loan amendment and upsized their notes by another $2.25 billion. That's nearly $5 billion.
Wow. Compared to a trailing revenue of just under $2 billion, that's a big bet.
A huge bet. But management has a timeline for the payoff, and this is key. Operating cash flow is actually positive.
So the core business is healthy.
Very. And the guidance is for the company to be EBITDA positive by the middle of 2026, and then actually achieve net profit by the first quarter of 2027.
If they hit that, the debt becomes manageable very quickly.
Exactly. The assets they're building will be churning out cash.
Okay, let's shift to how the market is seeing this, because the stock price just made a really sharp move.
It was dramatic. On January 12th, the stock just surged. It was up 12.2% in a single day, closing around $91.94.
And what was the trigger for that?
A couple of things. The CEO came out and directly addressed some concerns about GPU supply, and they announced a big partnership with the Department of Energy, the Genesis mission.
So as a technical breakout, it looks like $80 is forming a new support level, and that move suggests the big money is finally getting over the bearish sentiment from last year.
I think so. The quantitative sentiment had been pretty mixed, leaning bearish, but a 12% pop on high volume like that signals a real shift. Capital is flowing back in.
But the stock is still incredibly volatile. I mean, you have that huge buying pressure, but you also have to look at the insider selling.
Right. You can't ignore it. The chief development officer sold around $19 million worth of stock over December and January.
Which is a lot. Now, it was part of a prearranged plan, so it's not necessarily a panic sell.
Correct. It's not a red alert, but it's an overhang. It's something you have to factor in. On the other hand, institutional ownership is holding steady around 30%, so the long-term holders aren't spooked.
And then there's the short interest. It's sitting at over 19% of the float.
Which is extremely high. That's basically dry tinder for a short squeeze.
So any more good news could force all those shorts to buy back their shares, pushing the price up even faster.
It creates a setup for a really explosive move to the upside if the catalysts hit.
Okay, so this is the perfect setup. High risk, high reward. Let's talk about the specific risks to watch and the catalysts that could drive this thing higher.
Top of the risk list, you have to mention the legal overhang. There are some fraud investigations that were launched by a few law firms.
And what were those about, specifically?
It was tied to the 2025 guidance cut. They basically had to admit they couldn't get chips fast enough to meet their own targets, which, led to accusations they'd misled investors.
But the stock already got hammered for that, didn't it? It fell like 60% from its IPO high at one point.
It did. So you could argue that risk is mostly priced in, but it's still a legal process that's ongoing.
Okay. So putting that aside, what are the positive catalysts to watch for in the next, say, 3 months?
Number one is earnings. Q4 2025 results should be out in February or March. The market needs to see that they're still beating expectations and, more importantly, that they reaffirm that guidance for EBITDA positivity in 2026.
And what about the partnerships?
They're crucial. We need to see tangible progress on the Department of Energy's Genesis mission. That's a huge stamp of validation. And continued updates on scaling with Runway and, of course, hitting their milestones with the NVIDIA Rubin integration.
And then there's the macro picture. The debt load makes them very sensitive to interest rates.
Hugely sensitive. If the Fed starts cutting rates later this year, as many expect, that's an enormous tailwind for them. It lowers their borrowing costs and makes that whole balance sheet strategy look a lot smarter.
So wrapping it all up, what's the consensus view from analysts who cover this full-time?
They're still very constructive. They're focused on the long-term demand. The consensus price target is around $123.81.
Which is about 40% higher than where it's trading now.
Exactly. And you see some, like Citigroup, with targets as high as $135. They believe the moat is real and worth the risk.
So the investment thesis really comes down to execution. The demand is there. The tech is there. It's all about whether management can deliver on that timeline to profitability.
That's the whole story. Can they scale this incredibly complex physical business while keeping those software-like margins? Their success completely depends on executing that Rubin deployment and proving the demand is durable with partners like the DOE. It's the definition of a high-risk, high-reward play.
So keep a close eye on those Q4 earnings coming up and any news on the DOE Genesis mission. If they deliver, that path to the 120 consensus target looks very, very clear. Make sure you're subscribed so you don't miss our next analysis.